Hi, welcome to Accounting 201, Chapter 1, Introduction to Financial Statements. For this chapter, I'm using some of the publisher slides and some of my own. Our textbook is Financial Accounting 8th edition, publisher Wiley, 2016 by Kimmel, Wygant, and Kiso. I like this book and have used it before. Kimmel does a good job of covering the topics along with in-depth detail and some really helpful example problems. This is an introductory chapter that starts with identifying forms of a business and uses of accounting information. Then it talks about the 3 basic business activities, and finally you will be introduced to the financial statements and learn how to prepare 3 of them. Let's start with the form of businesses. The first form of business is a sole proprietorship. Most small businesses use this form. It is easy to start up. The owner has 100% control over all decisions, and there are certain tax advantages. The tax advantages have to do with the owner's business and the owner's personal finances all being combined together. By doing this, the owner pays taxes on the combined income. Why is this an advantage? Stand by, please. I'll get to the answer. Next form of business is partnerships. They can involve 2 people or more. Some of the big law and accounting firms have thousands of partners, but the principle still holds. Each partner has a share of the ownership, depending on how much of the company the partner buys into. The tax advantages continue. There is shared control and there are more people involved in leadership. Thus, the possibility of having more talent to run the company. But as you've probably already learned in your personal life, having more people to make a decision means it takes longer to make decisions. Finally, corporations. Corporations are big and small, but we tend to think of them as huge corporations like Microsoft, Boeing, or Amazon. Corporations' owners are called stockholders. They buy into the company by giving the company money and receiving stock in return, which represents just a percentage of ownership. There are no rules about transferring ownership, unlike a partnership, which might require that other partners approve of new partners. Stockholders just sell their stock when they no longer want to be a partial owner of the company. It is much easier to acquire funding, and most importantly, corporations have limited liability, no personal liability, which means that if the corporation goes bankrupt, the creditors, people the company owes money to, cannot go after the stockholders like they can with a sole proprietorship or partnerships. So that's the advantage of a corporation. However, there are some disadvantages to a corporation. The person who is a stockholder pays taxes, and the corporation also pays taxes. In sole proprietorships and partnerships, that doesn't happen. You only pay taxes 1 time, not 2 times. Why do we need financial information? Well, internally, the employees of the company need financial information. For example, the people in accounting and finance might be asking, is there enough money to pay dividends? Or is there enough money to give raises? Marketing would be trying to figure out, what price should Apple charge for an iPad to maximize the net income, or whatever the latest Apple product is. Management might be trying to figure out, what is our most profitable product? Should we stay in, for example, Pepsi, should they stay in the snack line, or should they just stay in beverage line? Should we get rid of any products? And of course, human resources is going to look at whether there's money for raises. So the Cliff Bar story. Full disclosure here, I do not like Cliff Bars, but I do like Kind Bars. So the Cliff Bar Company was created by Gary Erickson and his mother. In 2010, they did an employee stock ownership plan, which gave the employees of the company 20% ownership. This is highly unusual. This decision also caused Cliff Bar to make its accounting information open book, which allowed all the employees the opportunity to learn about its finances. This is huge for a company, and so employees are able to be more aware of how what they are doing impacts the company. Okay, let's look at external users. We have investors, so people who are outside of the company wanting to decide if they should buy stock in the company. Are they doing well? Are they going to give us a return on investment? Will they be able to pay dividends? Creditors, that means people that the company owes money to. Will they be able to pay their debts when they come due? So if they're going to sell things to the company, they want to make sure they're going to be paid. Other investors might say, I want to compare the Disney company with Time Warner, and so they need that financial information to be able to make those comparisons. I want to stop right now and say, even if you are not an accounting major, and honestly, even if you do, there are many ways which you can use accounting. So you may start out in accounting and go into general management. You may never go into accounting and go into general management. It's really important that you can look at the accounting data and make the right business decisions. You need to understand the story of business, the language of business, and that's accounting. Again, the marketing people need to understand what the selling price is versus the actual cost of the product or service. Of course, in finance, accounting, there's a use for accounting data, but the area of finance is not actually accounting. It is where we look at how we manage the funds of a corporation or how we invest the funds of the corporation in other companies. If you want to go into real estate, it's important to understand the finances in a real estate transaction and how we establish whether a buyer is a good person for a loan. Are they going to be able to pay off that loan? Finally, we look at ethics in accounting. Ethics are a big part of what it means to be an accountant. All certified accountants must agree to a code of ethics. We know, however, that some accountants act unethically. I want to say right now that that is very rare, but they do get a lot of exposure in the newspapers and in the media when they do act unethically. And you can probably recognize some of these names: Enron, WorldCom, HealthSouth, AIG. Congress passed, in response to some of these unethical behaviors, Congress passed the Sarbanes-Oxley Act, and it really helped to crack down on some of this behavior, and it required additional reporting. What happens when there's an ethical dilemma? Part of what you learn in an accounting major is to recognize an ethical situation. And what are the principal elements of the situation, and who are impacted by it, and who are the various stakeholders? You won't know that today in this class, but we will practice some ethical cases. What would you do if your boss told you to give the auditors incorrect information? That's an ethical dilemma. What would you do if your boss told you, we lost money last quarter, but I don't want you to tell anybody that? And how do you resolve those situations? We'll get into more of that in the next few months in this class. Let's look at different business organizational forms. Easiest to raise funds. What would that be? Simple to establish, no personal legal liability, tax advantages, and easy to transfer ownership. Remember, these answers are going to be sole proprietorship, partnership, or corporation. If you want to pause the video at this point and guess, otherwise I'm going to go on to the answers. finally, which of the following did not result from the Sarbanes-Oxley Act? Top management must now certify the accuracy of financial information. Penalties for fraud activity increased. Independence of auditors increased. Tax rates on corporations increase. Again, if you want to pause the video, you can. Otherwise, I'm going to post the answer. This concludes our first part of the financial statements video.